Singapore REITs, real estate investment trusts, have been correcting from their March and April highs. And this has been worsened by news of a resurgence in COVID-19 cases. The REITs market naturally doesn't like this. But if you're one of those who lamented not getting in on Singapore REITs when they climbed off their lows in November last year, well, here's another opportunity. But so many REITs, and CGS-CIMB research has ad ratings on a pretty wide range of REITs. But I'll tell you which one I like best among CGS-CIMB's ad-rated REITs. Let's start with the worst hit sectors, retail and hospitality. Now, hospitality will depend on resumption of travel, which will likely come a lot later in the recovery. But effective management of the pandemic and resumption of retail is a more realistic near-term prospect. So retail. And within retail, one of the worst affected is Frasers Centrepoint Trust. It is down 7% from its March high closing price. This is a heartland retail play, and it has all the hallmarks of heartland resilience. Its occupancy rate has remained high at around 95%. And it has a long WALE or weighted average lease expiry of nearly 5 years. Its properties are household names. At this very time, Frasers Centrepoint is trading at Singapore dollars 238. Now it rose from a low of 205 in November to a high of 266 in February. Now, the so-called 61.8% Fibonacci retracement of that move from November to February is 236. There should be some technical support at that level. But of course, if the COVID-19 situation worsens, it may go lower. But these are pretty attractive levels. On our forecast distribution per unit, we are looking at a yield of around 5% for FY21, rising to 5.4% in FY22. And it is now trading at 1.04 times book value. And if you're the sentimental type, the sort who look back at what could have been, remember, it is now only 78% of its pre-COVID-19 high.